Oh my God. If you're watching this right now, you already know exactly why we're here. It happened. Silver didn't just tag $70, it blew straight through it and printed a fresh all-time high at $71.11 per ounce in US markets. That's right, 71.11. The line everyone swore couldn't be crossed. The level everyone said would hold forever. The level where the banks were supposed to unleash every trick they had, their so-called kill switch. It didn't work. It failed completely. Ladies and gentlemen, Asian guy here. Today is one of those landmark days in the silver market we'll be talking about for years. December 23rd, 2025, the day silver proved physical demand rules and paper games are cracking. If you've been loaded up on physical silver miners or even futures, congratulations, this is your moment. If you've been sitting on the sidelines, lock in, because what happened today changes the whole story. We're going to break it all down, the exact price action, how we got to $71.11, the pullback, geopolitics, inventory drain, and why banks failed. Let's start with the numbers because they're unreal. As of December 23, 2025, spot silver surged to an intraday peak of $71.11 per ounce. That's the first time silver has ever hit $71 with a real breakout. Kitco captured it clean. Trading Economics showed closes near $70.96, while Reuters and FX Street confirmed silver crossing $70 on safe haven demand. Year-to-date, silver is up roughly 137% to 140%, putting it among the strongest performances since the late 1970s. From under $30 at the start of 2025 to $71, this isn't just a rally, it's a regime change. December alone delivered over 35% gains. Today, silver opened near $69, climbed through Europe, then exploded in the U.S. session. Volume stayed hot even with the holiday backdrop. COMEX March futures closed strong around $71.14, up 3.61% in some reports. Then came the pullback, prices slipped back toward the $69 to $70 zone by the late session. Why? Simple, classic profit taking. After a spike like that, traders grab gains, especially during thin holiday liquidity. A bit of dollar strength crept back in with the DXY up about 0.3%, and that brought some selling pressure. But this isn't a trend change. It's consolidation. It's the market catching its breath after ripping nearly $18 in less than a month from the November lows. That's completely normal in a bull run this intense. Futures equivalent prices still held above $70 on the close. The breakout remains intact. To put things in perspective, the old all-time high from 1,980 was around $50 nominal, which would be well over $150 today when adjusted for inflation. In 2011, silver peaked near $48.70 after a powerful multi-year run. For decades, silver was held down, chopping around in the $20 to $30 range while gold surged ahead, but 2025 changed the entire picture. First $50 broke, then $60, then $65, and now $71. The pace of the move is classic parabolic behavior. The time between each $10 advance keeps shrinking. The jump from $60 to $70 happened in days, not months. And the banks tried everything. Margin requirements were hiked in mid-December, jumping from roughly 9.5% to 15% under the excuse of managing volatility. There were rumors of spoofing fake sell walls meant to scare traders and endless talk of emergency measures. None of it worked. $71.11 still printed. The so-called kill switch emergency rules liquidation-only trading force majeure to crush a squeeze failed miserably. Physical demand simply overwhelmed the paper market. Why? Because this move isn't built on hype alone. Its fundamentals pushed into overdrive, and understanding them explains what comes next. Geopolitics lit the fuse today, and not in a subtle way. U.S. Sanctions on Venezuelan oil tankers escalated sharply. These weren't just warnings anymore. Real enforcement actions hit ships, detained, insurance withdrawn, payment channels frozen. Venezuela's already fragile oil system is now under direct economic pressure from multiple directions. Then came the cyber angle. A confirmed cyber attack on PDVSA, the state oil company, knocked systems offline, disrupted operations, and potentially reduced production for weeks or even months. So why does this matter for silver? Because energy disruptions translate directly into inflation, risk, rising costs, supply uncertainty, and capital flowing into hard assets. As Venezuela's oil situation deteriorated and energy markets grew jittery, silver caught a powerful bid. Safe haven demand surged, and this wasn't just retail money. Institutional flows showed up, sovereign players adjusted positioning, and even central banks quietly increased exposure. But that's only the immediate spark. The bigger picture is much broader and far more powerful. We're living in a world where geopolitical risk is rising on multiple fronts at once. U.S., China tensions remain unresolved. The Middle East is still a tinderbox. Russia and Ukraine continue without resolution. Tensions around Taiwan haven't gone away. At the same time, BRICS expansion is challenging. Dollar dominance and de-dollarization efforts are accelerating globally. Trade is increasingly being settled in yuan, rupees, or even gold. All of these forces push investors toward real, tangible assets. And even at $71, silver remains deeply undervalued relative to gold when you factor in historical ratios and the metal's growing industrial demand. The market is only beginning to reflect that imbalance. Then you layer in the Federal Reserve signals. Today we got fresh remarks from Governor Christopher Waller, typically one of the more hawkish voices, openly talking about more room to ease in 2026. Markets reacted fast and started pricing in 2 rate cuts for next year. The December FOMC dot plot already leaned in that direction. Lower rates reduce the opportunity cost of holding non-yielding assets like silver and gold. The dollar softened early in the session, not a breakdown, but enough to give metals a push. And when you mix falling rate expectations with rising inflation anxiety, driven by geopolitical energy risks, you get the kind of setup precious metals love. Reuters basically captured it with the headline, "A perfect storm of rate bets and geopolitics." That's exactly what played out. But even that still doesn't fully capture the deeper force behind this rally, the supply and demand fundamentals that have been building for years and are now hitting a critical pressure point. Let's talk deficits, because this is where the story turns truly explosive. We're now in the 5th straight year of structural silver deficits, 5 consecutive years where global demand has exceeded global supply. Estimates range from roughly 95 million ounces to about 149 million ounces. For 2025, projections cluster around a shortfall of 118 to 149 million ounces. Some people hear deficit and shrug, assuming more supply will show up or recycling will close the gap. But here's the reality. Mining output is basically flat. Global mine supply has been stuck around 800 to 850 million ounces a year for several years running. And there's a structural reason for that. Silver is mostly a byproduct. Roughly 70% of it comes out of lead, zinc, copper, and gold mines. So you can't simply crank up silver production unless the economics encourage more production of the primary metal. With those metals facing their own constraints, capex shortages, permitting delays, and ESG pressure, meaningful new silver supply isn't arriving quickly. New silver mines take 10 to 15 years to move from discovery to production. There's no cavalry riding in for 2026 or 2027. The mines that could matter are the ones being planned right now for the early 2032. Meanwhile, existing operations are dealing with depletion pressures that continue to limit output growth. Mexico, the world's largest silver producer at roughly 200 to 230 million ounces per year, is facing regulatory uncertainty, labor friction, and rising resource nationalism. Peru, the second largest, has similar headwinds. And there's no giant new discovery waiting in the wings that's suddenly going to flood the global silver market. Recycling helps, but it's not a magic fix. Industrial recycling, pulling silver from electronics, solar panels, and medical equipment, contributes maybe 150 to 200 million ounces annually. But a huge share of industrial silver is effectively consumed, spread out in tiny amounts per device, making recovery uneconomic at scale. Solar panels are the perfect example. Each panel contains only a tiny amount of silver, and the recycling ecosystem for end-of-life panels is still being built out. On top of that, when prices rise, hoarding behavior kicks in. People become less willing to sell old silver items if they expect higher prices ahead. So supply stays stuck around roughly 1 to 1.1 billion ounces total mining plus recycling, while demand runs closer to 1.1 to 1.3 billion ounces. That gap has to be filled somehow. And the only place it can come from is above-ground inventories, silver sitting in vaults, ETFs, and strategic stockpiles. Now let's talk about industrial demand, because this is what makes 2025 fundamentally different from 2011 or 1980. Back then, silver's biggest rallies were driven mostly by investment flows and speculation. This time, industrial demand is leading, and it's far more inelastic, meaning manufacturers still need silver even as prices rise. Solar photovoltaics are the largest industrial use. For 2025 estimates put solar demand around 260 to 300 million ounces, up from roughly 197 to 232 million in 2024. Global installations are accelerating across China, the U.S., Europe, and India. Even with thrifting, reducing silver per cell, installations are growing faster than those savings. And here's the twist. Newer high-efficiency cell technologies like TOPCon and HJT heterojunction can actually use more silver per cell, on the order of 30% to 50% more. So as the market upgrades to better performing panels, silver intensity can rise even as engineers try to reduce it. Electric vehicles are another major demand engine. Each EV uses roughly 25 to 50 grams of silver. That doesn't sound huge until you scale it. When you're talking about millions of vehicles like BYD producing around 5 million this year, or Tesla targeting 2 million plus, those grams turn into a serious pile of ounces. For 2025 estimates for EV-related silver demand are roughly 50 to 100 million ounces, including both the vehicles and the charging build-out. And every charging station needs silver to roughly 15 to 30 grams in contacts and wiring. With global targets requiring tens of millions of chargers by 2030, that's cumulative demand that's essentially locked in. Then there's the AI and data center boom, the wild card almost nobody was pricing in just 2 years ago. AI servers and massive GPU clusters running models like ChatGPT, Claude, and Gemini require high-density power delivery and aggressive thermal management. Silver shows up in conductors, connectors, and thermal interface materials throughout this rapidly expanding infrastructure. A single AI server rack can use 2 to 3 times the silver of a traditional rack. Hyperscalers like Microsoft, Google, Amazon, and Meta are expanding AI capacity at breakneck speed. Current estimates put AI data center silver demand at around 5 to 15 million ounces in 2025, with projections for 2030 reaching 50 million ounces or more. And that's before you even count the steady categories: consumer electronics, phones, laptops, appliances, medical, antibacterial coatings, imaging, industrial catalysts, mirrors, bearings, all stable to rising. Total industrial demand now makes up roughly 55% to 60% of total consumption. That's why the surge to $71.11 isn't a bubble, it's a repricing. Now, let's talk investment demand, specifically what's happening in ETFs and in physical coins and bars. Globally, silver ETFs hold around 1.1 to 1.2 billion ounces. The giants include iShares Silver Trust SLV with roughly 500 million ounces, Sprott Physical Silver Trust PSLV with 200 million plus, and many smaller funds worldwide. In the first half of 2025, ETFs saw net inflows of about 95 million ounces. That's not just paper exposure. In theory, when investors buy into these funds, the funds typically have to acquire and vault physical metal. When SLV adds 10 million ounces, that's 10 million ounces effectively removed from the open market. Year to date, in 2025, SLV has reportedly seen inflows exceeding $2 billion, with 1 month hitting around $1.5 billion. That's not just retail excitement. That kind of flow looks like institutional positioning, pensions, hedge funds, and larger pools of capital, building exposure for higher prices and inflation hedging. PSLV crossed roughly $10 billion in net asset value in mid-October and has been climbing since. These flows matter because they're sticky. ETFs aren't day trading vehicles. They buy and hold, and once that metal is vaulted, it's effectively locked up. That dynamic quietly removes supply from the open market and tightens conditions over time, especially when inflows persist and redemptions remain minimal during periods of rising prices and macro uncertainty. On the physical side, coins and bars, the picture is mixed but clearly improving. The U.S. Mint reported about a 30% decline in Silver Eagle sales in 2024 versus 2023, but that drop wasn't because demand vanished. It was largely about high premiums and the fact that many stackers were already positioned. What's changed is Q4 of 2025. Demand has reaccelerated. Retail premiums are still holding around $2 to $10 over spot, sometimes higher for Eagles or Maples. Dealers report tight supply in certain items, longer wait times, and strong buying from both new entrants, driven by FOMO, and experienced stackers adding on dips. Globally, coin and bar demand is expected to rise about 7% in 2025 after a 22% drop in 2024. That 2024 decline looks like profit-taking after the 2021 and 2023 moves. But now, with prices breaking records and geopolitical anxiety climbing, retail demand is clearly coming back into the market. And once mainstream media starts blasting silver at all-time highs headlines, the retail wave usually doesn't trickle in, it floods. If anything, we're still early on that curve. That brings us to what's becoming the most critical piece of the puzzle, the COMEX inventory picture and what's really happening behind the vault doors. COMEX silver is generally tracked in 2 categories, registered and eligible. Registered is metal available for delivery against futures contracts. Eligible is metal sitting in COMEX-approved vaults but not registered for delivery. Eligible silver is privately owned and can be registered, but there is no obligation to do so. For years, the system relied on eligible inventories as a cushion, but recent vault reports show more than 3 million ounces withdrawn from eligible inventories in the 2 weeks leading into December 23rd. That's holders choosing to remove silver from the COMEX system entirely, not registering it, not delivering it, just taking it out. And registered stocks, they're basically frozen. No meaningful inflows. The The metal that's already there is staying registered, maybe because some holders are hedging with futures, but fresh supply isn't arriving to offset withdrawals tied to deliveries. That's the pressure point, and it's where the system starts to feel stress when demand remains elevated. Here are the numbers. Around mid-year, 2025 total COMEX silver inventories registered plus eligible were roughly 460 million ounces. By late December, that total is closer to 450 million ounces. That's about a 10 million ounce net decline over 6 months. It doesn't sound massive, but the direction matters. More importantly, the drawdown has hit eligible the hardest. Eligible has fallen by roughly 15 to 20 million ounces, while registered has stayed fairly steady or even ticked up slightly as some eligible metal converted over. The system is quietly leaning on a shrinking pool of metal that isn't actually committed to delivery. But here's the real kicker. In just the last 2 weeks, more than 3 million ounces left eligible, with almost nothing coming in. If that withdrawal pace persisted, you're looking at something like 50 million ounces a year disappearing from eligible stocks. And it's happening while prices are at record highs. Normally, high prices bring metal out. People sell into strength. But this time, high prices are triggering the opposite behavior. Holders are pulling metal because they expect even higher prices ahead, or because they don't trust the system to perform if a genuine squeeze develops under real delivery pressure. Why would someone pull eligible silver? There are a few reasons, but they all point to the same message. This isn't over, and I want my metal under my control, not sitting in a vault where it could get tangled in a default, a rule change, or emergency measures. First, you've got strong hands accumulating. Large players, family offices, sovereign wealth funds, maybe even industrial users see the deficit, math, industrial demand growth, and geopolitical risk. They're choosing delivery, not paper-moving actual bars, into allocated storage they directly control instead of relying on exchange systems. Second, there's deep distrust of the COMEX system. In 1980, liquidation-only rules crushed prices. In 2011, margin hikes ended the rally. The fear is that if silver truly squeezes again, rules will change to protect the system. If you're holding eligible metal, why take that risk? Pull it out now. Third reason, premiums. Physical silver is trading above paper. Retail coins and bars are running $2 to $10 over spot, and some specialty products go even higher. If you're a dealer or refiner holding COMEX eligible bars, you can withdraw them, convert them into retail products, and sell into that premium. Why leave metal sitting as eligible, earning nothing? Fourth reason, rehypothecation and leasing concerns. Eligible metal isn't guaranteed to be sleeping quietly. It can be leased, pledged as collateral, or shifted around inside a system that isn't always transparent. In high volatility moments, a lot of owners simply want maximum clarity and control. The result is straightforward: eligible drains out while registered, doesn't refill quickly enough. Now zoom out and think about what happens if this continues. If eligible keeps shrinking and registered stays flat or starts falling too, the deliverable pool tightens. COMEX open interest in silver futures is enormous, hundreds of thousands of contracts, each worth 5,000 ounces. Most contracts settle in cash, but even a small percentage standing for delivery changes everything. If even 5% stand for delivery or 10%, that's suddenly millions of ounces of demand aimed at a registered stockpile that might only be 100 to 150 million ounces. In a normal market, that's manageable. Eligible holders convert, new metal flows in, the pipeline refills. But that's not what happens if owners refuse to convert and metal doesn't arrive. That's when you get a squeeze. Not the typical speculative squeeze where shorts cover and price spikes temporarily, but a structural squeeze where there simply isn't enough physical metal available to meet delivery needs. That's when exchanges are forced into cash settlement, emergency rule changes, or worst case, a delivery failure. The banks know this. The commercials know this. That's why they reached for the kill switch toolbox: margin hikes, spoofing rumors, whatever levers they still have. But it didn't work. Price still printed $71.11. Why? Because the demand driving this move isn't just leveraged speculators. It's physical buyers, industrial users, and sovereign-sized capital. And zooming out even further, COMEX isn't the only arena. Shanghai matters too. The Shanghai Gold Exchange is the key hub for physical metal trading across Asia. Chinese demand for silver has been huge industrially because China dominates solar panel and EV production, and as an investment for inflation protection and wealth preservation. And SGE silver inventories have been declining as well. Some reports are calling it multi-year lows. China is using more silver than it's bringing in, and domestic production isn't closing the gap. When Shanghai inventories are thin and COMEX stocks are sliding at the same time, the global pool of metal available for sale tightens fast. That's when arbitrage is supposed to kick in. If Shanghai trades richer than London or New York, metal should flow east. But shipping takes time, and if the premium isn't wide enough, it doesn't pay. And when supply feels tight, traders hesitate to move bars around because replacing them later could be difficult or expensive. The result is a more fragmented market: New York pricing COMEX, London pricing, LBMA, Shanghai pricing, SGE, and then the real-world physical market for coins and bars. In calm conditions, those prices stay tightly connected. Under stress, they drift. And we're seeing early hints of that drift now: rising physical premiums, delivery delays, and persistent vault withdrawals. Those are classic footprints of a market under strain. Now let's hit the elephant in the room: JP Morgan and the long-running manipulation narrative. For years, really decades, the silver community has argued JP Morgan was the dominant short, keeping prices capped. And there's a hard piece of evidence that supports part of that story from the legal record. In 2020, JP Morgan paid $920 million in penalties tied to spoofing in precious metals markets. Traders admitted to placing deceptive orders to influence prices. That's not speculation, it's in the legal record. But here's the twist. Over the last few years, there have been repeated claims that JP Morgan has changed sides entirely. Instead of being the monster short, they've supposedly been accumulating physical silver. Estimates are huge: roughly 500 million to 750 million ounces held in their own vaults, separate from COMEX-eligible categories. If that's even close to accurate, it would make them one of the largest private silver holders on Earth. Why would a big bank flip? Because the math shifted. A structural deficit is a long game, industrial demand is sticky, and trying to hold down price indefinitely with short exposure becomes a losing strategy over time. The smarter play would be to unwind shorts and accumulate physical when prices were cheap. JP Morgan's more recent research tone has been noticeably more constructive on silver, pointing towards $70 plus scenarios and citing deficits and industrial demand growth. That's a sharp contrast to the historically cautious framing many remember. Does that mean manipulation is gone? Not completely. Spoofing and algorithmic games can still appear, but incentives matter. If JP Morgan is meaningfully long physical, they're not motivated to smash prices anymore. They may still prefer controlled volatility. Meanwhile, other banks may remain short, hedging, or stuck in old positions. The balance of pressure in the silver market, though, is starting to look very different. But the grip is clearly loosening. Today's kill switch failed because the major players are no longer acting in unison to suppress price. Some are long, some are neutral. The short side is losing cohesion, and that's exactly why $71.11 printed. Despite every attempt to contain it, the physical market is now overpowering the paper market. So let's talk about what comes next, because $71 isn't the finish line, it's just a checkpoint. Forecasts for 2026 are increasingly pointing to much higher levels. Let's walk through some of the key outlooks. Peter Schiff, a longtime bull on gold and silver, is calling for $100 silver in 2026 based on renewed easing and persistent inflation pressure. His thesis is straightforward: the Federal Reserve will eventually be forced back into easing, whether openly through QE or quietly through balance sheet expansion and emergency facilities. Inflation, in his view, will remain elevated or re-accelerate, and precious metals will act as the pressure release valve. Schiff has been early before, but his record on major metals turning points is difficult to dismiss. Clem Chambers, founder of ADVFN, goes even further, calling for $100 plus silver, driven by an AI-powered energy supercycle. His argument is that AI's massive electricity needs stress grids, force huge infrastructure investment, and ignite a broader commodity boom. Silver as a critical input for energy and electronics benefits disproportionately from that structural shift. WisdomTree takes a more conservative stance, projecting roughly $75 silver by the end of 2026, factoring in rate cuts, a softer dollar, and supply constraints. Meanwhile, BNP Paribas and several other banks have quietly lifted targets toward $100 by mid-2026, pointing to tightening supply and accelerating industrial demand. These are mainstream institutions adapting to new market realities. Kitco surveys show 2026 expectations, clustering around $80 to $90 with a wide range. Some see downside to $60 if a deep recession hits. Others see upside to $150 in a full squeeze. Ultrabulls cite 1,980 parallels, arguing $150 to $200 is possible. No outcome is certain, but structural deficits, locked-in industrial demand, rising investment interest, and tight physical supply clearly tilt the odds higher. My base case is that $75 becomes the next major resistance zone. A test in Q1 2026 looks likely. If that level breaks decisively on volume, a rapid move toward $85 to $90 is very possible. From there, $100 comes into play by mid-year. There will be pullbacks, but the dominant trend is still pointing higher. Bull scenario price blasts through $75 and doesn't look back. We see $90 in Q1, $120 by mid-year, and potentially $150 if a full-scale squeeze ignites. This outcome unfolds if industrial demand surprises higher, EV adoption accelerates, AI infrastructure expands aggressively, and or COMEX delivery stress triggers panic buying across the market. Bear scenario, an economic slowdown or outright recession cuts industrial demand by 10-15%. Investment interest fades, silver retreats into the $60-$65 zone, and prices chop sideways for several months. Even in this downside case, the deficit doesn't disappear, it merely shrinks, and any recovery would likely restart the upward move. Dollar strength is a real risk. If the Fed pauses, rate cuts, or hints at renewed tightening due to stubborn inflation or a resilient labor market, the dollar could strengthen. A firmer dollar usually weighs on commodities. If DXY pushes from 106 toward 110, silver could consolidate or dip into the $65-$68 range. Economic slowdown is another risk. Recession concerns could dent industrial demand. EV sales might cool, solar projects could be delayed. Data center expansion could slow if AI enthusiasm fades. A 10% drop in industrial demand would remove roughly 100 million ounces from consumption, narrowing, but not erasing the deficit and easing near-term pressure. Other risks include technological substitution, supply response, and regulatory intervention. Breakthroughs, reducing silver use, are unlikely short-term and take years to scale. New mines take years to develop. Recycling can only rise so far. Exchanges could impose emergency measures, but with industrial users deeply involved, such intervention becomes harder politically and economically. So where does this leave us? If you're holding physical silver, congratulations, you're positioned for what could become a historic move. The frustration of recent years, the long sideways grind, false breakouts, and endless manipulation debates has led to this moment. $71.11 is confirmation, but it's not the finish line. It's mile marker 20 inches, a marathon. If you're new or still on the sidelines, don't chase blindly. Volatility is part of the process. Sharp pullbacks will happen, and 10-15% corrections are completely normal in a bull market this powerful. Those pullbacks are opportunities. $71 may feel expensive right now, but if the trajectory points toward $100 or higher, dips into the $65, $68 range are a gift. So, how should you position? Physical first always. Coins and bars with delivery in hand. If your goal is wealth preservation, relying on paper promises defeats the purpose. If you're looking for leverage and are willing to accept risk, miners are the lever. Junior miners can offer 5x to even 10x exposure, but they're volatile and unforgiving. Focus on companies with solid balance sheets, low operating costs, and credible growth pipelines. For most people, the real question is allocation. What percentage of net worth belongs in silver? Traditional models suggest 1-5%. But if you see this as a once-in-a-generation setup, some investors push allocations to 10-25%. That choice is personal, but zero exposure looks increasingly questionable. Zooming out, this is about wealth transfer. Wealth is shifting from paper claims to physical ownership, from weak hands to strong hands. At $71.11, confirmation has arrived. Mainstream attention will follow CNBC segments, Bloomberg interviews, social media buzzing, fresh capital pouring in, retail FOMO, institutional catch-up, maybe even an ETF rush. But the biggest move is still ahead. When industrial buyers can't source metal at reasonable prices, when COMEX registered inventories fall below 50 million ounces, when vaults are drained and dealers have nothing left to sell, that's when $100 will look cheap. The grinding sideways phase was the transfer period. Enjoy the calm while it lasts, because when the storm breaks, availability vanishes and price moves vertically. That's why you're seeing desperation in certain corners trying to control the narrative, cap the price, and stall what feels inevitable. But they can't fight reality. They can't print silver. They can slow things down, but they can't erase the math. And today, at $71.11, the kill switch didn't work. The paper system lost its grip. Physical won. Tomorrow, higher. Next week, more volatility, but the trend stays higher. And next year, if the fundamentals hold, the deficit persists, and the crowd piles in, this becomes a repricing event people will study for decades. This isn't a normal rally. It's a structural shift that rewrites how silver is valued in the global system. This is your moment. Hold the line. If you're trading futures, demand delivery. Be the strong hand when weak hands panic sell on dips. Add on weakness. Respect strength. But don't get comfortable. The battle isn't finished. It's simply moving into a new phase where pressure builds and mistakes become more costly. And to everyone who's been here through it, thank you for being part of this movement. While mainstream media snoozes, banks scramble, and governments act like everything is fine, you're here learning, questioning, and positioning ahead of the crowd. This isn't just a channel. It's a community that understands paper isn't wealth. The silver squeeze, the COMEX stress, the repricing, this is only the beginning. $71.11 is the start, not the finish. I'm John. Remember to like and subscribe. Share this. Wake up your family and friends. The window to position is narrowing. The crowd is coming. Be early. Stack smart. Stay strong. The future is silver.